So, welcome again everyone to a lecture video and lecture series on marginal costing and absorption costing. So in this series, we did be looking at and be winding up an episode on marginal costing and absorption costing. In previous lecture series on this topic, we've been able to look at the concept of marginal and absorption costing, the distinction, difference between marginal and absorption costing. We've also been able to look at the relevant costing and the relevant revenue principle. Conclusively, in this class, we'll be looking at the different applications of the marginal costing approach. Different practical applications where we can use marginal costing in reality, in practical, where the knowledge of marginal costing can come to play a great role to the management or for strategic decision making. So which circumstances, which scenarios, which practical situation or illustration can this come to play a pivotal role? So, one of the circumstances or scenario where cost accountant or management accountant uses the marginal costing approach is what we refer to as when decisions involves the make or buy decision. This type of situation arises when a manufacturer, when a manager, when the firm, when the management is faced with the decision as to whether to manufacture one of its components in-house or buy such components from an outside supplier. Don't forget that most firms that involves in manufacturing or production of their own output makes use of different components. Now, to produce product X, they might need for raw materials such as material A, material B, material C. Now, the use, the consumption, the utilization of all these raw materials would be used to produce an end result of finished goods called or termed product X. This is referred to as the production or the manufacturing cycle. Raw material gives birth to work in progress, give birth to finished goods. Now, in the quest of gathering this raw material, the management is always faced with the decision of, should we make this raw material? This component, material A component or material B component or material C component, which of these can we make in-house? Considering our level of expertise, considering our area of specialization or concentration, considering our spare capacity. Do we have spare capacity? Even if we can actually produce them, can we actually manage or cope with their production in such a way that it will not stop our current existing normal production cycle? So, should we make it in-house, or alternatively, should we buy such type of component from outside supplier? In this case, we say that the management, the manufacturer, the firm the organization, the manager is faced with either to manufacture in-house or to outsource to an external supplier. On this wise, we say that we could actually apply the principle or the techniques of marginal costing. But in a bid to apply the marginal costing technique, there is an underlying decision rule or decision criteria. This decision rule states that if the outside supplier's quotation is greater than the total variable cost, notice the word total variable cost, not the total cost. Are you getting it? Not the total cost that comprises of fixed cost. Don't forget that marginal costing itself only reckons or deals or recognizes only the variable cost, not any other cost. So, if the outside supplier's quotation is greater than the total variable cost of producing the component in-house, then the component should be manufactured in-house. I believe you understand this decision criteria. It says or stipulates that if the outside supplier's quotation, the external supplier will actually have a quotation price or a quoted price they are willing to supply this raw material or this component to us. Now, the assumption or the criteria stipulate that if this supplier's quotation is greater than our own total variable cost, that is the incremental cost that we are going to incur, note that it does not include the fixed cost. Rather, it is the total variable cost that we are going to incur as a result of making this component in-house. Then it's rational that we should actually outsource to this external supplier, as we'll be able to save some cost. On the other hand, the decision criteria or the decision rule states that if the total variable cost of in-house production is higher than the quotation of the external or the outside supplier, then it will be quite discreet for the management to purchase the component from the supplier. I go again. If the total variable cost of in-house production is greater than the quotation of the outside supplier, then it is quite discreet, it's quite advisable, it's quite rational, it's quite profitable for the management to purchase the component from the supplier. So, I believe you've been able to understand the rationale governing this decision criteria. This is it. If the supplier quotation is higher than our own total variable cost in-house, then we produce in-house. Because if we go to the supplier, we'll be incurring more. So it's better and it's discreet and it's manageable to produce in-house. Whereby, if the supplier quotation is on the other hand lower than the cost we will incur to make the goods in-house, then it is profitable, it is discreet, it is wise enough, it is rational that we rather go to the supplier to purchase, as we will not be able, as we will actually be saving the cost or the excess cost will have incurred by making in-house. These are the decision criteria governing the application of marginal costing technique in a make or buy decision scenario. Howbeit, in this regard, there are quite other number of qualitative factors. Now, the decision criteria is only predicated upon quantitative factors. The figure of the external supplier, quoted price, and the figure of our total variable cost actually is what this decision criteria is based upon. But there could be some other qualitative factors that plays a pivotal role, a great role, a vital role in a decision-making circumstance involving a make or buy scenario. For example, the level of expertise. If our own expertise level cannot be compared to that of external supplier, for example, the quality that we'll be able to produce is substandard or of lower standard compared to what we'll be able to get or what we'll be able to derive from purchasing from the external supplier, then it will be better to actually opt for the quality product or component of raw material from the external supplier, as it will go a long way in providing or yielding a quality finished product, such that we will not lose our customer reputation in the long run. Other factors could be confidentiality. In actually opting that an external supplier supplies us, in that regard, then there will be one way or the other be need for us to disclose some of our confidential information to this external supplier. And the risk there is that these suppliers could turn out in the later period of future to become a threat or probably a main competitor for us. So, another qualitative factor is, will this external supplier be able to meet up with our delivery time? Will they not cause delay in our production cycle? So all these qualitative factors also plays a great role in the make or buy decision. So, we'll be moving forward to another application of marginal costing, which we refer to as the decision on whether to accept or to reject a special order. What we refer to as acceptance or rejection of special order. Under this decision, the management is at a loggerhead or at a crossroad on, does the price quoted by the special customer cover the marginal cost of production, or does the company have excess capacity? These are important factors to ask yourself that the management must be able to decipher solution to before either to accept or reject a special order. Number one, the price quoted by the special customer, though, is going to lead to an additional profit, but yet, does it cover our marginal cost of production? If it does not cover our marginal cost of production, definitely it does not also cover our fixed cost. So in that case, we are making a loss. So it will be better not to embark or to accept such special order. But even if it covers our marginal cost of production, the question is, do we have an excess capacity? Do we have a spare capacity that we can use to produce this special order? These two questions are the most germane question that must be answered on the application of marginal costing on scenarios pertaining to acceptance and rejection of special order. On this note, I'd like to congratulate us and as many of my students there that we've been able to successfully complete a lecture course or tutorial or professional discourse on marginal costing and absorption costing. On this great wealth of knowledge that you have acquired, I could 80% to 90% vouch that you are able to face or attempt any form of professional or academic assessment that have to do with marginal and absorption costing. I believe we'll be able to learn a lot and to gather enough archive of wealth of knowledge. On this note, please go to our YouTube channel, LearnCity, subscribe, like the video, and share with your professional colleagues and loved ones. Also, check up our website on LearnCity and follow up subsequent videos that will be released. In the next episode, we'll be looking at under cost and management accounting is a technique, vital technique called linear programming. So, as you continue with us in this new episode, I want to say, I remain my humble self, Mr. Joseph, also called Prof. Thank you and God bless you.